FX, price construction and spreads. So, as I said, everything works in pairs. So here you're buying Australian dollars and selling US dollars. So you're selling US dollars in order to buy Australian dollars. So now the quote, so that's the price basically. So we can see here, Australian dollar is called the base currency. So if price goes up, that's the base currency, Australian dollar went up. The US dollar is the quote currency. So the base currency is always 1. What I mean by that is 1 Australian dollar is equal to 0.73 US dollars. So 1 Australian dollar could buy $0.73. If we look at the dollar against the yen, we can see $1 can buy 110 Japanese yen. Then we can see there's actually two prices, what we call the bid and the ask. So this is the bid and this one is the ask. You can see it clearly here. So here are all the currencies with the bid price and the ask price. So basically the ask price is what they are asking for you to buy, and the bid price is what they are asking you, the price asked to sell. So when you're looking to buy, let's say, Aussie CAD, so the Australian dollar against the Canadian dollar, the buying price will be 0.9668 and the selling price will be 0.9667. So what you notice here is that if you buy at this price and then sell it straight when you just bought it, so you buy it at 96.68 and sell it the next second, exact same price, you will actually sell it at 96.67. So you've lost 1 here, 1 digit. So whenever you buy something or sell it in order to enter the trade, you start with a small loss. And that small loss is due to what we call the spread. So the spread is how a broker makes money. So your broker will make money in the spread. So let's look at here. The US dollar against the Japanese yen. The bid price 8,555,872. So we can see here the difference is about 2 pips. So whenever you buy, basically the broker makes a profit of 2 pips. Okay? And so now you need to understand what is a pip, because that's the name we give to basically points in forex trading. So a pip is, to make it simple, a pip is the 5th number. Okay? So let's look at dollar yen here. A pip would be the 5th number. So 1, 2, 3, 4, 5. This is the pip. So when this is 1 pip, so here we can see the bid and the ask. The difference is approximately 2 pips. Now let's look at pound Aussie. So, pound Aussie. We could see the price here. So that's the bid, that's the ask. So here the spread is 6 pips, 14 and 20. So that's how you calculate how many pips the spread is, but your broker will always say the spreads because that's something competitive, that each broker wants to have the lowest spreads because the lowest spread is the best entry you can have. So let's look at, for instance, in a trade, let's say you've made a wonderful trade and just bought the US dollar against the Canadian dollar up until here. So you bought here, sold here. How many pips have you made? Well, let's see. With that tool, it tells you. So first of all, you can look at the price. So you bought a 1 point, let's say 30, and sold at 1 point, let's make it 32. 1.32. So that will be a total, let's say the 5th number, so 1, 2, 3, 4, 5 is a pip. So up until here, it went from 30 to 32, that's 200 pips move. So this little measure will help you. Just to see it quickly, you can see approximately 200 pips. So that's important to know. Now, there's a trick with the spread. So I told you a broker makes money with the spread. However, the spread moves. So when volatility is really high, spread also widens. So you need to be really careful about this. For instance, when the market just opens on Monday morning, spreads are massive because like liquidity is low and just markets are opening. So spread is massive. So please don't trade during that moment. Why? Because let's say yesterday was Monday and I was looking to short pound Aussie. And the spread on the Monday morning was 20 pips. So 20 pips, you could see that it's all that move. So let's say I want to buy here. I'm actually getting my entry 20 pips above. So that's not great. But the worst part is, let's say you buy this here. You buy it, that's your target. So your target is there, stop loss here. If you're buying it here, price goes down. It doesn't reach your stop loss, so you shouldn't lose. However, you can see there, that little distance is 10 pips. So if the spread is more than 10 pips, you will get stopped out, even though the price didn't actually reach the level you set your stop loss. So it's really important to always check the spreads. Don't check it like all the time, because during the day, spreads should be low. But like if there's a special news coming out, like elections or like Brexit or something, spreads will be massive. Yeah, it's when markets have something special, when they're open, when they're about to close, when something's happening, a lot of volatility. So yeah, really important to look at. And so yeah, so that's how price construction works, and spreads and pips.